From Deloitte Tax, welcome to the Tax News and Views podcast, where we talk to specialists from Deloitte about the latest business issues and developments. I'm Carrie Falkenhayn, your host for Tax News and Views, and today we are revisiting the topic of reporting for digital assets. On August 25th, the IRS and the U.S. Department of Treasury issued the long-anticipated proposed regulations under Section 6045 and 6050W, which provide guidance for information reporting for digital assets. These regulations provide the details to the Infrastructure Investment and Jobs Act way back from 2021 that required brokers to report digital assets transactions by the customers. These new proposed regs have laid out effective dates for reporting to be on or after January 1st, 2025 on the new Form 1099-DA. All that is new. So joining me today to discuss what types of transactions are covered by these reporting requirements, as well as the parties required to make the reporting, are three Deloitte specialists in the area of global information reporting. We have Denise Hinsky, who I've talked to in the past and is Deloitte's Global Information Reporting Market Leader. And we're joined by Connor O'Brien and Jonathan Cutler, both from Deloitte's Washington National Tax Practice, specializing in blockchain digital assets. So Denise, I'm going to start with you. And I understand that these regulations address a number of issues around broker reporting, but they also leave open a number of issues. Can you add a lens on what was and what was not addressed that leaves ambiguity for the players in this area?
Sure, Carrie. This is a very voluminous reg package. It's over 280 pages in total, and it actually modifies a number of different sections of the code in addition to Section 6045, which deals with the broker reporting. Maybe I'll start first with what's not covered. This includes items such as rules for the cash basis reporting under Section 6050I, which were, of course, also introduced by the legislation. The treatment of mining and staking rewards, which were the subject of a recent revenue ruling and may be reportable under Section 6041. Digital asset lending, wash sales, and attribution rules. The bulk of what is included in the reg package focuses on providing details around who has a reporting responsibility under Section 6045 and what that responsibility looks like, including the specifics of what needs to be reported on the new Form 1099-DA, the application of backup withholding rules, and the extension of the penalty provisions to this reporting. It only provides very limited guidance around transfer statement rules, primarily indicating that the current transfer statement rules that are found under Section 6045 do not apply to digital assets, and that further guidance on transfer statements will be coming out in the future. And in some cases, it actually does not make changes to existing rules. For example, in the definition of an exempt recipient, which in and of itself then has an impact. There is also a whole section on payment processors and their responsibilities when they facilitate payments in digital assets, as well as a wealth of other things that are covered here. I could probably go on and on forever, but I think I'll leave it at that.
Well, as I learn more about this space, it's clear to me that there's not just one type of digital asset business, right? You described some of those, but there's many types of digital assets in amongst themselves. So Jonathan, maybe you could talk about what some of the differences are, and are they all equally impacted by these proposed regulations?
Yeah, thanks, Carrie. So first, I think it's important to put aside preconceived notions on what a broker is. A broker in street name, what we're all used to in the stock and bond space, is now expanded to include a very wide, diverse array of persons transacting in digital assets on behalf of others as a part of their trade or business. The way we think about this world is ever evolving. As with any regulation, the moment the regulation comes out, business is innovated in a way that perhaps has outpaced some of the definitions. Treasury anticipated that and defined things in a very broad way. We've tried to capture our industry players, our digital asset ecosystem members and participants in a few different buckets. The first I'll speak to is CeFi, or centralized finance, and TradFi, or traditional finance. We can think of these as our centralized exchanges that we all know and love, where the common man who's not into the technology, not as deeply engrossed in the space as perhaps our other guest, Connor O'Brien, is, might go to buy a digital asset, a centralized exchange, or TradFi, our traditional banks and brokers that have now decided to offer digital asset purchases, trades, transfers, and other maybe more unique financial products on their platform. They are clearly targeted in these regulations as parties that are now defined as digital asset brokers for their activity in transacting in digital assets on behalf of others. And there are a number, as one might expect, of compliance requirements. Traditional information reporting rules applied to digital assets, documentation, withholding if it's needed, although we hope not. If you get it documented, you hope to not have to withhold. And then, of course, the reporting on this new Form 1099-DA. Payment processors is our second player in the space. And we expected this one to be included, although there are a few twists and turns that we might not have anticipated. Inclusion of Section 6050W, for example, which is the Form 1099-K reporting by merchant acquiring entities, credit card companies, and TPSOs, third-party settlement organizations that process payments on behalf of merchants. When they do that, involving digital assets, they are now also included as digital asset brokers. And they have reporting requirements with respect to not just the customer interacting with the merchant, but in some cases, the merchant. And there are coordination rules between whether amounts should be reported on Forms 1099-DA or Form 1099-K. The third player in this space is our wallet providers and token issuers. Now, this is the most gray area of player space that we've defined here, because some of these folks, wallet providers and token issuers, are in the requirements for these regs as facilitative service providers. And some, if they solely sell technology, license, some form of software to manage the digital keys of a customer, but they do not, in fact, effect sales, quote unquote, a term of art in the regs, they would not have requirements. And some of our wallet providers and token issuers are not within these requirements because, for example, they only manage the private keys of a customer acting as their wallet, and they do not, in fact, effect sales, quote unquote, a term of art under these regulations on behalf of customers. And others may be doing more than solely providing a license for a software or selling software. They, in fact, act as on-ramp and off-ramp for the trading of the digital asset. And in that sense, are in the position to know or have the ability to know of the event that generates gross proceeds, the sale of the digital asset.
So you talked about the fact that CeFi is in scope, but what about DeFi? I had understood that there was a lot of industry pressure to exclude DeFi transactions from the scope of the regulations. Did this end up happening?
That industry pressure is not gone, but as with our crypto asset reporting framework rules promulgated by the OECD that have continued to been updated recently, and in fact, future guidance under CARF, what it's titled as, is promised for DeFi. These regulations do also include DeFi, our fourth player in the space. And DeFi is a tough one. If I thought wallet providers and token issuers were gray, DeFi is sometimes a little bit more of a black box where really the facts can be so disparate and different between each DEX or DAO or other DeFi player in the space that it requires a lot of thinking and a lot of assessment to determine, am I in fact a broker under these rules? The important differentiators here are whether one would know or be in the position to know the identity of the customer, and whether one would know or be in the position to know of the event generating gross proceeds. Being in the position to know is clearly meant to include parties who have intentionally or unintentionally designed their platforms or their technology to not identify a customer, to not be involved in the payment flow when one transacts in digital assets. However, because one is in the trader business of affecting sales on behalf of customers, when they, for example, provide the rails on which the digital assets can swap, or in other instances, provide the mechanisms for trading, they may be included as a broker. A few indications of inclusion in this definition might be, for example, taking a trading fee. Although we certainly know friends in the DeFi space don't always take a trading fee. They might, in fact, transact in a native coin to that DEX or that space. Even in that context, if they have the ability to control the terms of the trade, they may still also be included.
Connor, let's bring you in here. So in the case of DeFi or a decentralized organization, who would be the reporting party?
That's a great question. And, the interesting thing is that the proposed regs pointed the finger at a few potential parties that might have this reporting obligation. All DAOs are created differently, and there's different aspects of control in each one of these organization designs. In some instances, holders of governance tokens might actually control upgrades and updates to the underlying protocol, in which case there's potential that that group could be obligated to report here. In other circumstances, founders of a decentralized finance construct may retain certain aspects of control as it relates to upgrading those platforms. And perhaps the founders may be those that are obligated to report. So there's really a broad array of potential parties in the DAO and DeFi construct. And it's something that's really facts and circumstances oriented. So you need to understand how these are constructed and where those aspects of control lie.
So still some ambiguity around who has to report, but let's talk a little bit about what information needs to be reported, right? Because there's been an expectation that reporting is required for a while. Is this just a matter of using a new Form 1099-DA, or are there other tax considerations at play for these new brokers?
No, so we actually got, proposed regs under Section 1001 and 1012 along with 6045. And those two really actually refine how you're going to calculate any gain or loss on these transactions, and also get into basis recovery methodologies and appropriate means of doing so. So the proposed reg 1.1001-7 really deals with the computation of a gain or loss on the sale or exchange of a digital asset. And the important thing that really drew our eyes in was you determine your gross proceeds at the date and time that those proceeds were received. So this is a little bit different from the traditional securities market. And as we say, crypto never sleeps. These markets are always active. So they're really honing in on the time that the transaction occurred to determine the value. Another interesting thing is how they are telling us to treat transaction costs. And, in some circumstances, transaction costs are going to be treated as a disposition cost and really affect the gross proceeds in determining the realized gain or loss. And in circumstances where you're exchanging one digital asset for another digital asset, they actually tell you to split that transaction cost, treat half of it as a disposition cost for the asset that you're selling and half of it as an acquisition cost. So it gets capitalized into the basis of the asset that you're acquiring. In addition, under the proposed regs for 1012, it's 1.1012-1H, they go through the rules in determining the basis of digital assets sold. And this has been a long debated topic. How do I determine my basis? The FAQs that the IRS originally released said that you can spec ID, and if you don't spec ID, you resort to FIFO. And, there's been a lot of debates about what that means and how to appropriately account for that. So we did get some clarification here. And notably, the IRS is saying that your basis recovery methodology under 1012 for digital assets is not a method. And they also provided some useful insight in terms of what could possibly be considered specific identification methodology. And, they even throw out examples of being on a FIFO methodology, a HIFO methodology, or a LIFO methodology. And those might, would still be viewed as a specific identification, kind of equivalent to standing orders.
Denise, let's bring you back into this discussion as the global leader around information reporting. How do these rules impact non-U.S. companies?
Carrie, the proposed regulations are actually pretty complex when they talk about non-U.S. entities. The rules do make it clear that both controlled foreign corporations, or CFCs, and other non-U.S. brokers are subject to the requirements and have a responsibility to report on a Form 1099-DA to the extent that they do a digital asset transaction for a U.S. client. However, the rules regarding the collection of tax documentation, the application of presumption rules when documentation is missing, as well as what actually needs to be reported on the forms differ depending on whether or not the foreign entity is a CFC, and also whether or not the foreign entity is registered as a money service business. A non-U.S. entity that's registered as a money service business is going to be treated the same as a U.S. broker when it comes to the collection of Forms W-8 and W-9 and the application of presumption rules that kick in when documentation is missing. A non-U.S. entity that is not registered will generally be able to rely on indicia, including the IP address, which is being used by the client. That raises a lot of interesting issues, especially since somebody can generally change their IP address by going in through a VPN. I think it's also really important. Jonathan mentioned earlier CARP, and so I think it's important to remember that we also have these CARP rules coming out of the OECD, and then we have what are called the DAC 8 rules coming out of the European Commission. Both of these also impose documentation and reporting requirements with respect to digital assets. And they're going to be focused mainly these players in the foreign players here. So non-U.S. entities are definitely going to have their hands full.
It sounds like there's a lot for a lot of organizations to get their arms around. And I can imagine we're getting a lot of questions. Maybe you could all share what's top of mind from the folks you're all hearing from.
Yeah, I'll kick off here first, Carrie. There's a lot of focus on what these regulations actually mean to their business. So, I've been getting phone calls about what does this mean? Are we going to have to change, what we've been talking about doing? There's also quite a bit of concern about the tight time frame for implementation. These reporting dates look as if they're far out, but it really isn't, when you look at the amount of the lift that organizations are going to have to do in order to meet these requirements.
Hunter, how about you?
Yeah, I would say, I'm more focused on the crypto natives, like that's a personal interest of mine. And this is a whole new paradigm for, decentralized exchanges and wallet providers. And they have a lot of questions about whether they're in or out, first off. And second off, what are they going to do if they are in? Right? Is it really a time to pivot their business model such that they wouldn't be considered a broker and merely be providing their wallet service? Or, do they need to get serious and figure out, hey, how am I going to be compliant with these new rules and regulations coming into play? So I think those are interesting conversations.
Jonathan, how about you?
I'm getting a fair number of questions related to this money services business concept that Denise pointed out. In the payment processor space, it seems more evident who might qualify as a CFC or non-U.S. digital asset broker that is an MSB, treated as equivalent to a U.S. broker. And in other contexts, it's a bit confusing. There's some FinCEN guidance out there that might point to digital asset facilitators also being included as money services business. Very confusing set of rules. They shift the presumption rules and documentation requirements in the midst of that. And it's created an instance where parties are saying, hey, I understood the rules before, and now these kind of new set of rules that are underneath the old set are creating some confusion. And we're trying to step alongside and help clients think through that morass of guidance.
Well, thank you all. Really useful information as our audience increases their knowledge of digital asset businesses, as well as their related reporting requirements. Very helpful. If our audience wants more information, you can always reach out to Denise, Jonathan, or Connor via LinkedIn. You could also download the Deloitte Tax at Hand app. It has lots of information around global information reporting, as well as many other global tax topics. Thank you all for listening in. I hope you tune in next time, and I hope you all continue to be well. Take care, everyone.